In this video, we're going to discuss risk and rates of return. This is a fundamental concept in decision making. We need to understand first how to quantify the rates of returns that you expect to get with certain types of investments. So we want to talk about how you measure that. In addition, we have to talk about the concept of risk. Most risk can be quantified. Some of it is very qualitative. We're going to concentrate on the quantifiable kinds of risk. How do we measure risk from our predictions of cash flows, etc.? So, first of all, we've already talked about that. We know there are two considerations of risk and return. Each decision has certain kinds of risk characteristics, certain kinds of return characteristics. In fact, any decision you make, it doesn't have to be a financial decision, but any decision that you make has some risk in it, since every decision you make involves some prediction of the future. So we want to understand how we can measure these things, right? So we're going to start looking at a single asset, how we measure risk and return for that. Then we're going to talk about what happens when we combine those single assets into portfolios, into a group of assets, if you will. So there's two types of investment risk we'll talk about: standalone risk and portfolio risk. So investment risk is related to the probability of earning a low or negative actual return. Now, that is the textbook definition. The challenge with that is it really doesn't match the math that we're going to calculate. So we'll talk about that a little bit later when we actually get to some formulas. But obviously, the greater the chance of lower than expected returns, the riskier the investment is. So when you think of investment risk, again, in the context of this analysis here, we're really looking at the chances of getting something lower than you want or lower than you expect. So again, let's kind of put that into a nutshell, if you will, right? Total risk is a measure of the uncertainty surrounding a return that an investment's going to earn, right? The variability of returns associated with a given risk. So it has to do with uncertainty and variability. Alternatively, and again, here's the definition that I really like: risk is the chance that what you expect to get, you do not receive. So you get something different. Sometimes it could be good, sometimes it could be bad, but it's different than what you expect. Now, the return of something is kind of, I don't want to say it's self-defining, right? But it's the total gain or loss you get over a period of time. And we have various ways to calculate that. Now, returns can be realized. That is, you get them, you have them, but you're holding them. You're not selling the investment. An expected return is you expect to get this. It's a prediction based on some analysis that you've made. So returns can be either realized or they can be expected. So let's think about some realized returns, things that actually happened. From 1926 to 2019, this data shows us averages, right? So let's kind of look at I'd like to start here in the middle. Treasury bills, United States Treasury bills. On average, they earned about 3.4%. So Treasury bills, United States government securities, are very low risk. What we'll find out in some upcoming slides is we measure risk. One of the ways we measure is standard deviation. You can see the number here is 3.1, very low. Long-term government bonds, 6%, a little bit riskier. Corporate bonds, 6.4%. You see there's a little mix up here. This is mostly because long-term government bonds aren't truly market driven, right? There's some government interference in there with their rates of returns. And they are created with the idea of earning a 6% return. That's what is expected on those government bonds. But let's look at stocks. Large cap stocks. Think about this as being the S&P 500. They averaged in this time frame, right, 12.1%, had a standard deviation of 19.8. Now I think it's time to kind of talk about this, right? When I say 12.1% average return, that doesn't mean, of course, that every year it earned 12.1. Some years were negative. There are a few years that were actually double-digit negative returns. Most years are positive, and some of those years are actually even double-digit positive returns. So if you invested $1 in 1926, it would have averaged about 12.1% per year for this entire time frame. Now, small stocks averaged around 16.3%, but had a much higher standard deviation. The point we're trying to make with this graph here is that as we go up the column here, we're getting higher and higher returns, and for the most part, we're also getting higher and higher risk. So it appears that combining or the higher risk investments tend to earn higher or have higher levels of risk. And we can even create some portfolios. 90% stocks, 10% bonds gives us around 11.4%, right? Somewhere in between these two. And the risk is around 17.8. Again, somewhere in between those two. 70% stocks, 30% bonds, 10.2, 14.1. So as we start to combine things, if you combine more things that are low risk, like bonds, with the high risk things, you're going to get slightly lower returns, but you also get slightly lower risk. So let's move on and talk about how we calculate returns. Now, there's a formula. It's called the holding period return. And it's a very basic formula. I like the second part of this. It's just easier. You take the cash flows earned during the period and add to that PT. That is the last price that you know. Divide that by the beginning price of the investment. Now, this is for a 1-year holding period, and then subtract 1. The challenge here is if you have a holding period that's greater than 1 year, this at the very least needs to be annualized for that time frame. So there is a worksheet that's referred to as the holding period return. It's part of the risk and return workbook, Excel workbook that's provided. And if you look at this, we have 2 stocks. We bought 200 shares of each. Microsoft started at 73 and it ended at 106. P&G started at 92. It ended at 80. And Microsoft had $100.65 in dividends, and P&G had $2.81 in dividends. So how can we calculate the returns? The spreadsheet hopefully is kind of descriptive. Put the beginning and ending values. Put the investment cash flows, right? That's the dividends that were paid. And in this case, the time frame, which was 1 year. So in this case, Microsoft earned 47.3% in this 1 year. and P&G earned a negative 9.29. Now, you'll notice here that the return and the holding period return, where it says annualized, they are the same because this is a 1-year investment. Now, obviously, if it takes longer to get to the same place, the average return per year is going to be less. So again, there'll be some problems we'll talk about a little bit later when we talk about what happens if you change the investment time. So how do we measure returns? So one of the best ways is to think about prediction, right? We're going to predict future returns. So we have a very basic formula here. Sigma says add the things after me together. So you take the returns and multiply it by the probability that that return occurs, and then you add those all up. We'll see an example here in a second. Now we can also do this with historical data. So if you do the rate of return every year for the last 50 years and divided that by 50, you'd have the average rate of return per year. This is a predictive model, and this is looking at history, right? The challenge with the predictive model, obviously, since we're talking about, we have to think about what's the chance that things are going to happen, right? The probability implies that whatever the return is you think is going to happen, there's a chance that it won't happen. And again, this is kind of getting to my definition of risk, that there's a chance that what you think will happen won't happen. Standard deviation, again, we can do a historical calculation on historical data, or we can do the predictive model. And again, this is the formula that really describes that definition, right? Probability implies chance. R bar here is what you expect to happen. R sub I is what you think will happen in a particular period or event. So there's a difference between what you think will happen and what actually happens. Take the probability, multiply by the chance of it happening, and again, we add those things all up. Take the square root, gives us this thing called standard deviation. So in general, the higher the standard deviation, the greater the risk. One of the things we can do, though, is you divide the risk by return, and that gives us a relative measure of dispersion. So if you're making comparison, that's a little bit of a better statistic to use. How can you predict probabilities? Well, maybe we'll send out some surveys to some economists, and we're going to ask them to respond to a question about GDP, right? What do you expect GDP to be in the next year? And we'll give them, we'll let them choose whatever number they want. But when they provide us with their answers, we're going to create a frequency distribution. So we're going to say, look, if they say that the GDP is greater than 4, they're saying they expect a very good economy. Now, we received our surveys and 20 people said that. So of all the people that returned this, of all 200, that's 10%. So this over here now is our probability that these economic events are going to occur. So now we're kind of set and ready to start doing some calculations of what we think will happen to stocks. So now we want to calculate these statistics. And we'll do that in the next video.